few days ago, the Australian Treasurer, Josh Frydenberg, has passed a bill whereby he's easing the responsible lending requirements of the major banks in Australia. Now, this responsible lending regulation was enacted 10 years ago in Australia. And the purpose of this law, just after the global financial crisis of 2008, was to restrain the flow of credit into the economy through the banks. Particularly the banks were restrained from lending to people that had higher risk of defaulting on their loans or could potentially face servicing of their issues with servicing the loans. Now, the fact that this law has now been eased, it could potentially be a watershed moment for people that are looking to take out home loans in the future, business loans or personal loans. And could also have potential implications for the residential property sector and the commercial property sector. So to discuss this in a bit more detail, I sat down with my colleague from Banyan Tree Investment Group. His name is Zach Riaz. He's one of the co-founders and he's one of the investment managers at the firm in Sydney. And we had a broad-ranging discussion on this topic. I hope you will stick around to watch this show to the end. You're watching Max Riaz on Business Today on Pehchan TV. So we've got Zach Riaz online from Banyan Tree, one of my colleagues at the firm there. Zach's been cordial enough to offer his time today to discuss the change of the responsible lending law in Australia. Zach, are you there on the other side?
Yeah, hi Max, how are you?
Not too bad, thank you, Zach. Zach, so I've just given the audience a bit of an intro on what the Federal Treasurer, Josh Frydenberg, has ushered in terms of relaxation of the lending laws. Can you give us a bit of an overview from how you understand it? I know you put a research paper out to your clients recently, going into a whole heap of detail. Maybe some of it is probably too technical for our audience. Just the overarching, what's your feeling of where this relaxation of the lending may lead to in the economy?
Yeah, Max, as you know, obviously the team, once something of this nature gets announced, which has a material implication for a major sector, being the bank sector for the ASX, we reached out to various stakeholders, including major banks, to get a bit of understanding of what this actually means from a credit growth perspective, because when it was announced, a lot of the analysts, consensus started to, I guess, excited, and probably some enthusiasm was warranted, whether this means credit growth can really start flowing again, and whether all this costs that banks in the recent years, due to all these, when these responsible lending laws came through, these extra costs around compliance and extra due diligence on credit applications,
loan approvals,
loan approvals, whether all of that could be now removed. So, talking to the various stakeholders, I mean, long story short, it really is still a lot of uncertainty around how this actually plays out. From our feeling, there wasn't much consultation with the banking sector. I think they pretty much found out along with us. But the general feeling is that, look, credit is still available and was still available. It's a demand led issue right now, the subdued credit growth. And, there are a few more bells and whistles that clients and applicants have to go through. But it wasn't like it was significantly restricting it.
Yeah. So Zach, I read somewhere I think it was in the Financial Review, It touched on the fact that people, when they're applying for a home loan, let's say, where in the past the banks were a bit more onerous or looked more closely the people's expenditure behaviors around how they spent their money in the past 12 months or 6 months or whatnot, and how they save their money. The banks are going forward under this relaxation of this law would potentially take more of people's word for it. The article suggested that even if you didn't have the good savings behavior, if you went to the bank and said, "Oh, look, I promise I'll get my expenditure down and I'll save more in the future," the banks will take your word for it and will lend you against your word, as opposed to in the past they wouldn't have done so. They would have needed a bit more concrete evidence. So that's some what people are taking from this out in the market, and potentially that's why the stock market saw very favorably to the banking sector as well. This average share price of a bank went up 7-8% on the day when the announcement came out. I mean, what's your take on?
So essentially, and the banks will put what you've just said essentially as, look, the pendulum had swung too much in their direction in terms of they had to check everything that Max was putting down. They said there's a bit of responsibility of Max to understand his borrowing capacity and what he's putting down. All the basic checks about cash flow, about if you're being paid, if you're being paid what you're saying, it's very easily done. Banks can go into the bank statements. The verification process, it's not very onerous. So again, comes back to one of the points I made earlier. This notion around significant costs can be relaxed or can be removed. I mean, the process that banks have put in place, they're not going to suddenly stop following because of this rule. But what's absolutely important is that there is a responsibility back on the applicant to say, well, it's not the bank's duty to check every single thing you've put down. You've got to be honest and have integrity in your application as well. So I think that's what basically the banks have been arguing. And the other key point really is that there was, with this responsible lending, there was this uncertainty in the market on how conservative you should be. Some banks, some lending outfits were a lot more conservative and following the regulation to the T and what APRA had guided and ASIC had guided, and whilst other banks were not as relaxed. So there was this discrepancy. And certainly between the non-banks, non-major bank lenders who have been picking up market share in recent times, there was even a bigger discrepancy. So now from a banking perspective, for the major banks perspective, this certainly levels out the playing field. And what, again, as I said previously, the demand issue is still there. Credit was cheap before and was available before. Credit is still cheap right now and is still available now. It's still a bit of a demand issue from people, confidence issue. COVID has rocked a lot of consumers and obviously businesses and their confidences. So I think it's what you might see is banks start to become a little bit more aggressive. And while the overall pie may
aggressive as in more lenient in their lending, right?
But the process may be just sped up a little bit more. And what that means is, and then obviously, whilst overall growth may be subdued, banks will be able to pick up some of the market share they've lost. So Zach, market share.
So Zach, do you then, I mean, those of us who've got investment in property sectors such as commercial and residential market, how do you see that market, going forward now with the more stronger, and aggressive banks looking to lend potentially more, or being a bit more lenient in providing loans, and also generally, what's your feeling on the property prices going forward? Are we going to see some some easing in the prices, or are you seeing increases in property valuations going forward in the next 12 months?
So in terms of one important point before we move on about this whole credit growth really is it was pretty certain from our talks that it's the APRA rules that are more restrictive on the credit. And remember, there's a bit of background here. APRA and RBA end of 2014 brought in these rules because they're really worried about house prices, right? And they're worried about overinflation.
And APRA is the regulator of the banks, right?
Yeah, exactly. So they're the regulator. So the banks say it's actually their rules are more restrictive to this whole credit lending than the ASIC rules, which was responsible lending. So at the end of the day, house prices are still held up relatively well. So, I don't think it'll be off to the races in terms of house prices from here because of this announcement. I just think there's, house prices have held up relatively well anyway. Within the property sector, I think, again, you've got to be selective where you go in the property sector. Some of the property sector is actually impacted by structural changes, so, your, I guess your Westfields, your real estate, and that's related to shopping centers and whatnot. In that sector, in that segment, you probably want to be you want to probably be invested in the T1 assets, the ones that are really well located. With the property sector, again, I don't think you're going to see a change which is going to lead to significant changes in housing growth or house prices. But the broader, the recent the Australian budget is generally very good, well, very positive for growth. Or it's all about trying to get consumption, demand. And even the announcement around property wasn't anything new. I think they've extended the first home buyer scheme. But there wasn't any major, so from a construction point of view, I think $1 billion in housing, social housing was announced. That's only equates to 2,500 to 3,000 units. But generally,
that's good news. That's good news for developers and
so I think generally the property sector is fine, and I don't think they're going to relax the rule to inflate it anymore, and I don't think they're going to put any more pressure on it. So we'd be neutral on that, to be honest.
Zach, would you like to give a bit of a background on yourself and also tell us a bit about your firm that you represent, Banyan Tree Investment Group, who I'm also a part of, but I would like for you to just give us a bit of a color around what the firm does and your own background. Thanks.
So Banyan Tree started 5 years ago, and we offer research and funds management capabilities to high net worth individuals, family offices, financial planners, and institutional clients. Our backgrounds, including myself and most of my colleagues, like you, we've managed funds for large institutions. We've managed funds for family offices. So we have that buy-side, sell-side experience in institutional equity research and markets research. And direct, and one of the good experiences, and Max, you are a proponent of this direct industry experience, which is very valuable when trying to understand companies, supply chains, company operations. It really adds another dimension to our research. Gaurav, again, we used to work for a FMGC company as a financial controller, so it really helps. And we're bringing this 50-year plus of experience in managing money, looking at businesses, talking to business owners, CEOs at board levels, and we're bringing that combined experience in managing portfolios and mandates across asset classes.
So Zach, do you guys invest in the stock markets, Australia, international?
Yep. So we do Australian stock, ASX listed companies.
So you build portfolios. You build
portfolios for Australian stocks, correct? We also have a portfolio for global stocks. And then we have what is called a multi-asset strategy, which is a fund-of-fund strategy, where we do invest in one portfolio is invested in different asset classes across bonds, equities, alternatives, credit, and that gives you a much more balanced exposure.
Do you also manage superannuation?
So our funds in our strategies come from super money.
So just from average person who works, their
that's
superannuation. Yep.
Correct. And then obviously institutional high net worth money.
So how does that money flow through to you? So if I'm working and let's say I've got $200,000 in my superannuation, how does that come to you? Like, yep. How can you explain?
But mostly we deal for our retail super money. You've come through a financial advisor. We work with a number of financial advisors. So you
around Australia. Yep.
And around Australia. We're very fortunate to be around Australia now. But if a retail client wants access to our funds, which are available on Power App, which are available on Hub24, and Wealthflow 2. So but how you typically approach or get access to us is through a financial advisor who has to give you advice into our strategies, and you can ask your financial advisor about our strategies, and we're more than happy to run through that.
Okay, so if I say, look, I'm conservative, I don't take too many risks, I will talk through with my financial advisor, and he would suggest that if you have a conservative, Max Riaz has a conservative risk profile, then there would be a bit of my superannuation allocated to shares, bit to the commercial property or infrastructure or bonds. So you guys sort of put together all of that in its entirety, that portfolio with different asset classes for individuals matching their what they call risk profiles, right? So conservative to all the way to clients that are seeking aggressive growth. Would that be correct?
Correct. Yeah, that's correct. So we run across different risk profiles. And so all our risk profiles across aggressive to conservative are available on Wealthflow 2. On Hub24 and Power App. We've got our moderate growth, which is your 70-30, which most guys consider balanced. So you need to go through the process with a financial planner. And once you have ascertained what risk profile you are, then you can get access to us on a number of these platforms.
And the fees, how are your fees charged? Like if I go to an industry super fund, they're pretty good on the fees. That so they say anyway. I mean, how does your fees match with the rest of the investment management world, I suppose?
I mean, look, our fees are pretty competitive. We charge 25 basis points excluding the platform fees, which is obviously independent of us.
0.25%. 0.25% is
0.25%,
of the funds being invested
on a per annum basis. We charge no performance fee. I think investors trust you with their funds. I think that's incentive enough to do a good job rather than being compensated by extra.
So how does that compare? How does your fee compare to the average active manager out there?
Look, it's a fair question, but to be honest, I kind of frame it in a different way. We don't really focus on fees. I mean, we're pretty competitive, and the financial planner can go through all the different fees and structures. But I think what's important for clients to understand, and this doesn't matter whether you're coming to Banning or somewhere else, you need to understand the strategy you're going in, and you need to understand what the manager or the fund manager is trying to deliver for you, and over the long run. I mean, we've got a 5-year track record now where our moderate growth has delivered, I think, a touch above 6% per annum. So, from our perspective, our process has delivered that. What we're selling to you or what we're offering you is that process. Now, in that 6% per annum for the last 5 years, you've seen a pandemic. You've seen markets, which 2019 markets where everything was running. You saw the December quarter 2018 sell-off. You saw a Trump president come into the foray where everyone was cashed up, thinking the world was going to end. So, from our perspective, delivering what we deliver, that's what we come to it. But from a fee perspective, I think we're very competitive.
No, thanks for that, Zach. That was a good overview. So I hope you've enjoyed that conversation with Zach Riaz from Banyan Tree Investment Group in Sydney. Until next time and a new show with a new guest, I bid you farewell. Keep watching Pehchan TV.